What is going on, penny boys and gals? What's going on, stock traders? And welcome to another trading psychology stream. I'm going to go ahead and post our Trading 401 channel. That is where you can find all of the different classes for this trading psychology. It's around I think it'll be like a 15-week trading psychology session. So let me just pull up the Discord on the StreamYard so that everyone can see what's going on. We got Charlie, we got Jay, OG Nikki, as always, Stickman, Porterhouse, Tick to Cack, Vans, Victorious. What is going on? Let me just start pulling up the trading psychology. There we go. All right, so we are, once again, this is week 3 of our trading psychology sessions. This week we are going to be going over it. If you go to that Trading 401 channel, you can just see all the different classes right there. We're going over cognitive biases in trading for today. I'm just looking for my notes here. I had it under my documents. For some reason, just decided to go away. Last week we went over this. That's the first session. I know, Charlie, you were talking about Tilray in the chat. I know we've been trading some of these plays for a while now here in the blog area. Sorry, just bear with me for 1 second as I try to find my notes here for this class. I am currently in the middle of a move, so I'm on my laptop right now, and like all my stuff, like usually on my desktop, and so it's a little bit hectic. Here it is. This is on my other account. That's why. All right, so we're good. All right, so yeah, this is going to be Trading Psychology Week 3. Once again, this is going over cognitive biases in trading. We're going to be exploring some cognitive biases and their impact on decision making, and how to overcome or possibly overcome confirmation bias, overconfidence, and anchoring, which are 3 very, very, very important biases to just be aware of as traders. And then, of course, we're probably talking about what all they are, but that's not going to help unless we also go over strategies to mitigate the effect of these biases. So just basically strategies to help us in our trading, because when it comes to trading psychology or just trading in general, trading psychology is a very big factor that can very, very easily and very quickly affect our trades, even sometimes more than the knowledge of technical analysis or even fundamental analysis. Sometimes it's people who have the trading psychology down and the ones who actually are the best traders. I know Nikki has been from day one. Nikki's been very, very big on our trading psychology courses, ever since 2020 when we started posting them. So I'm glad that all you can join us today. So we'll be talking once again about cognitive biases, their impact on our decision making as traders. Nikki says they are my favorite. So cognitive biases are basically systematic ways of thinking that can affect our judgment in the markets or just in general. So during this class, we'll explore some common cognitive biases such as confirmation bias, overconfidence, and anchoring, and talk about strategies to mitigate their effects. So let's just first start with what cognitive biases are and how they influence our decision-making process. So cognitive biases are mental shortcuts or patterns of thinking that can lead us to make irrational judgments or decisions at times. These biases often stem from our brain's natural tendency to simplify complex information and rely on heuristics or rules of thumb when making judgment. So I know heuristics, that's a different term when it comes to trading, as opposed to other contexts. But in the context of trading and of cognitive biases and decision making, heuristics refer to mental shortcuts that our brain automatically makes. We basically use this to simplify complex information and make judgments quickly. So instead of having to think every single little thing through, it's our brain's way of being able to just quickly jump to a conclusion, basically. Heuristics are essentially mental strategies that allow us to solve problems and make decisions more efficiently, often by relying on patterns or past experiences. So sometimes this can be a positive thing, but sometimes it can be negative if we are relying on heuristics that might not be valid, especially when it comes to trading. So heuristics can be helpful in many situations, allowing us to make fast decisions with limited information. However, they can also lead to cognitive biases when they result in systematic errors in judgment. So that's basically just us, or the way that we learned, or the people we're listening to, just basically, it might be wrong. And even, so it might be our way of quickly getting to information, but information could be wrong based off of these biases we're going to be going over. So this happens when heuristics cause us to deviate from rational decision-making processes, leading to biases in our thinking. So, for example, one common heuristic is availability heuristic, especially for traders, which involves judging the likelihood of an event based on how easily we can recall similar instances or examples from memory. So, if we recently heard about a particular stock or crypto performing well, maybe like Tilray, we were talking about that one recently. I know Dogecoin, when it was going to, everyone was talking about $1. That was one that a lot of people kind of just jumped on, jumped on the bandwagon, even on the way down, because they just heard, oh, Dogecoin, or you know, Tesla, whatever it may be. They hear about these stocks, Nvidia, that are performing well, and because in their memory it performed well, they're thinking, oh well, it's going to perform well in the future, without actually making any fundamental or technical analysis. So once again, if we recently heard about a particular stock or crypto performing well, we may overestimate its potential for success in the future, leading to overconfidence bias. Another example is representative heuristic, where we make judgments or predictions based on how closely something resembles a typical example. Victoria says, or it's your friend's company. Yeah, that's true too. That's definitely a bias that your friends, like someone that is telling you something, or you might be biased towards that information because it's coming from a friend, or like Victoria was talking about, like our friend's company. So we have representative heuristics, where we make judgments or predictions based on how closely something resembles a typical example. So, for instance, if a stock's recent performance resembles that of a past successful trade that we had, so we're looking at the stock for Tilray, for instance, let's just say, or whatever XYZ stock, and we just recently played Uber and had a great trade on it. Maybe it was a day trade, swing trade, whatever, and we see that this current stock that we're looking at, stock XYZ, is looking similar to Uber. We may assume that it's going to follow a similar pattern, leading to anchoring bias. So it's not really based off of fundamental or technical analysis. There's one thing knowing how patterns work, and realizing that sometimes patterns might follow, might continue to happen. But it's another thing just saying, oh well, this happened once with this one stock, so it's going to happen again with this other stock, without actually having a strategy involved, or technical analysis or fundamental analysis reasoning behind that trade. It's just because you saw it in the past it worked, so it's probably going to work this time. That's the anchoring bias. Another cognitive bias that frequently affects traders is the anchoring heuristic. So this occurs when traders rely too heavily on initial information, which is the anchor, when making decisions, even if that information is irrelevant or outdated. So, for example, let's just say a trader buys a stock at $50 per share with the target of $70 based on either a Wall Street analyst, or Webull comments, or it could even be an alert. Which is why it's so important that we update the alerts, and like you have Lee and Bull and the people whose alerts you're trading. You have them here to ask questions, especially when if you're first getting started, because things do change in the market. And just because we bought stock XYZ at $50 per share with a target of $70 doesn't mean it's going to hit $70, or is even going to go up, for that matter. Anything can happen in the market, and so despite changes in market conditions or new information suggesting the stock's value has declined, or maybe a technical analysis pattern, bad earnings, whatever it may be, some traders might continue to hold on to the stock, which is anchored to the target of $70, which is that target they heard. And they're just kind of anchored to, all right, it's going to hit $70 eventually because Webull Comments told me, or, this Wall Street analyst told me, or whatever it may be. And this anchoring bias can prevent the trader from making, or us as traders from making, necessary adjustments to our investment strategies, potentially leading to losses, which is why having a trading plan is so important, but also knowing when it is time to adjust said trading plan based off either the market conditions or just us in general. We change as people as well. Our emotions do change over time, or something might happen. Happened to you in your life that changed you, and so it is important to be aware of that. And a plan that worked for you 2 years ago, it might not work for you now. Recency bias is another one. So I'll pull the chat really quick. There we go. Is another cognitive bias in trading. That's recency bias. That's involving placing too much emphasis on recent events or information when making decisions. So, for example, if a trader sees a stock's price sharply increase over the past few days, so stocks going up, 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 they may assume the trend will continue and buy the stock without conducting thorough analysis. However, this focus on recent price movements may cause the trader to overlook fundamental factors or long-term trends, leading to impulsive or short-sighted decisions. So basically, we see a stock that's going up, 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 up. So recently it's been going up. We think to ourselves, it's going to continue going up. But as we know, us who have been trading for a little bit now, and a lot of us have been through this even in our own trades. Things that that go up usually end up coming back down, 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 and correcting or whatever it may be. And so, it's important to, just because, a stock is recently doing well or a stock is recently doing bad or, recently XYZ is happening doesn't mean that it's guaranteed to happen in the future. There's also familiarity bias, which occurs when traders prefer to invest in assets or markets they are familiar with, rather than considering a broader range of options. So this could be a pro or a con depending on the person. Some people, I personally, I love to just trade one. When I was really, really, really putting some time into the market, I was strictly just trading one stock. It was Uber. I was options day trading, and I was just doing that same stock because I learned the stocks channels and how it worked, and how the investors who invested in Uber, how their emotions dictated the market flow during 12 o'clock hour during this patterns happen. And so for me, I got very much invested into just trading this one stock. And some people, that works really well for some people, whereas others, they need that diversification. So for instance, a trader may exclusively invest in stocks of a company within their industry or within their geographical region, believing they have a better understanding of those markets. However, this familiarity bias can lead to over-investing in certain assets, can lead to a lack of diversification in your overall portfolio. You could just honestly just be missing out on potential profits because you think to yourself, oh, I work in the XYZ industry, so I'm going to invest in XYZ industry stocks because I know about it. And that's great, but A, now you're really heavily invested in just one sector, so you're not diversified. And B, because the familiarity bias is kicking in, you're only looking at stocks in this one sector. You're not really allowing yourself to get the potential profits of possibly other opportunities elsewhere that might be more profitable. Whether it be the crypto market or whether it be options trading, or whether it be a different sector or futures trading, whatever it may be. It is really important to diversify and not let the familiarity bias negatively affect our trading. But once again, for some people, having that familiarity really does help them. So it really does depend, once again, on the person. For Victorious, it might work, whereas for OG Nikki, it might they might be the opposite. And that's why it's also really important just to be aware of what season it is. And I'm not talking about like summer, winter or whatever, but just when it comes to the market, sometimes crypto's hot. It's crypto season right now. It's meme coin season, especially in the Solana blockchain. So people who realize that, they might focus their attention to crypto these next 6 to 8 months, because they realize that this is the next bull run might be happening. We got the halving coming up. It's a hot time for crypto right now. And so as opposed to, so instead of maybe putting a lot of their effort into stocks or this, that, whatever, they might be now putting their effort into crypto. And then when the crypto season's over, maybe something happens in the market where lithium stocks, uranium stocks, are super hot, or the EV sector lights up really hot, and so then they switch their what they're looking at to that sector. It really does depend on the trader. Once again, some traders only just trade one type of asset, one type, even just one type of stock or whatever it may be, whereas others like to diversify. And then there's others who also not only diversify but also realize where they're diversifying based off of the current market. Once again, whether crypto's hot or a certain sector is hot. There's also herd mentality bias. It's another cognitive bias that traders like us should be aware of. This bias, I know probably a lot of us have fallen victim to this one, but this occurs when traders blindly follow the actions or decisions of the crowd without conducting their own analysis or due diligence. We always say, do your own research. So for example, if we see a whole bunch of traders buying a particular stock, they're talking about it, we will comments on Twitter, on Discord, whatever it may be, on Facebook, you see everyone's buying this one stock. You as a trader might feel pressure to join in, assuming that the collective wisdom of the crowd must be correct. If everyone's doing it, they must be on to something, is what we think. And unfortunately, this herd mentality bias can lead to the groupthink behavior and really increase the market volatility as traders ignore their own judgment and follow the crowd without considering the potential risks, which in theory could drive that stock or crypto, the asset up way past its actual value because the herd is buying into it, which eventually means it's going to come back down to where it should be trading. We saw that with Dogecoin, we saw that with AMC, with GameStop. Some people made a lot of money on it, but people who were just, because they were trading it based off of actual analysis. But then there's those who are just part of the herd. Everyone's talking about Dogecoin. I'm going to buy Dogecoin at 70 cents. Like everyone's talking about GameStop. I'll buy it at $320. Why not? It's just going to go up from here. That's the herd mentality, as opposed to realizing a plan, for trading these types of trades. Um, so in trading, understanding heuristics and the potential downfalls is crucial for recognizing and mitigating cognitive biases. Just like with anything when it comes to trading psychology, it's not just about understanding it, but it's also, about finding strategies to lessen, these emotions and lessen the emotional trading that we do. So by being aware of the mental shortcuts that we use, and sometimes it's even without thinking we use these mental shortcuts, by being aware of these, we can actively question if they work. Like so, for me, is that familiarity bias of Uber, is that working for me, or is it not working for me? For somebody else, it might be her mentality. I keep chasing stocks I see people on Twitter posting about. Is it working for me? Is it not working for me? So it's understanding these heuristics and realizing which ones work and which ones are which mental shortcuts are actually hindering your trading, making it in theory worse, is really really important. Because some of them can be pros and some of them can be some of them can be strengths, and some of them can be weaknesses. So it's good to be able to realize which ones are which as an individual trader. Another common cognitive bias in trading is confirmation bias, where we tend to seek out information that confirms our existing beliefs or hypotheses while ignoring or downplaying evidence that contradicts them. I mean, the fact of the matter is everyone likes to be right, right? And people have trouble being wrong, especially if it means losing money, because like we talked about last class, that loss aversion, meaning the fear of loss, is in every single person and every single trader. And so we are afraid of losses. We're afraid of losing. And because of that, we might overlook information that's telling us that might be saying, oh, the stock has a reason to go down when we're in a bullish trade because we want it to go up. We want that information to be wrong. And we're trying to, we're trying to will it to be wrong. That's just not how the market works. You can't just will a stock to go up or, news to be either, good or bad. You need to be able to roll with the punches in the market and, trade according to a plan. So for instance, if you're in a bullish trade for, let's just say, Tesla, and you see news come out and people talking about something bearish involving Tesla, you may overlook it as you don't want it to be true, as your original belief was that Tesla is bullish, and for you to make money, it needs to be bullish. And so you overlook all that information, all those facts are telling you, like, hey, maybe I should set a stop loss, or maybe I should have an exit plan here, or maybe I should buy a covered call, whatever it may be. All you're just ignoring all that because you want to be right and you want to have that confirmation bias basically win. And so people like being right. We as humans, we love being right. But in trading, it's not about being right or wrong. It's about being able to adapt when we are right or wrong. So that's the really important thing to keep in mind. Cognitive biases, they can lead us to overestimate our abilities, underestimate risks, and cling to outdated or irrelevant information, resulting in poor decision making and less than desired trading outcomes. I know I personally have let some of the things I just talked about. We just talked about in this class. Some of these biases, I've let them affect my trades in the past. Whether it was definitely herding mentality. I've definitely been a fallen victim to herding mentality. Getting in on either different meme coin crypto coins or different stocks or penny stocks, whatever everyone's talking about. Thinking that it's the herd is going to bring it up even further. Without actually conducting any thorough research. And all these other biases as well. All of us have definitely been through that at one point or another, no matter how good of traders that we are. So, we all go through it. So how can we mitigate the effects? How can we manage this? How can we mitigate the effects of cognitive biases and make more rational decisions in trading? Well, one effective strategy is to build awareness of our individual biases. So I'm talking about, you, Victorious, you, Nikki, you, Takak, Charlie, as individuals, not us as traders, as a group. It's because everyone is an individual when it comes to emotions. Like when it comes to charting, RSI is RSI, but when it comes to trading psychology, Charlie's trading psychology is going to be completely different than Takak's or mine or Victorious. And so it's really, 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 really important to build awareness of your own individual biases when it comes to trading and actively challenge your own personal assumptions and beliefs, because sometimes those mental shortcuts we're making just naturally, they might not be helping us. They might be wrong. And so we need to be able to challenge that. It's kind of like a code. We have these codes basically written in our heads and we just go by it. And sometimes it's important to challenge that code and be like, what, like maybe this isn't working. Maybe I should do XYZ instead. So, it's important to be aware and to be, humble enough to challenge your own assumptions and your own beliefs when it comes to just the market, your trades, your decision making when it comes to trading. So by questioning our own thinking and seeking out diverse perspectives, we can reduce the influence of biases on our decision making process. This is why we aren't a trading group led by one guru here at Penny Boys with one guaranteed to work strategy that's guaranteed to make you rich quick or whatever it is that people try to sell nowadays. That's not how trading works. It's not just one guru who teaches this one, strategy that always works. That's just not how it is. We're all different, and some strategies work for some people and some don't for others. And that's why we have 4 premium trading coaches in Swinging Bull, Lee, Jay, and Ethan, and 2 free trading coaches in Austin with his Smash and Pass Monday sessions and Pookie's Revenge with his Rags to Riches Friday sessions, and a whole bunch of guys as well. So you have different perspectives because it's not just about following one person who, is the guru who knows all things and, you have to do it their way. And this is not how it works here at Penny Boys or in trading in general. It's not how it should work for trading in general. So, it is really just important to, once again, just, look at outside perspectives and challenge yourself and challenge, your mental shortcuts and the things that, kind of have been ingrained into your head, whether it is, from the, society, from the way that we were raised, whatever it may be, the things that happened to us in the past, all these things affect our mental shortcuts, our biases, those are the big 3 things that really do affect us: the way that we're raised, things that might have happened to us in the past, and as well, what's going on? I am good at MC. You changed your name back. Yeah. So those are 3 things that really, really affect, our biases just in general, and just things to be aware of, and sometimes, taking assessments, trading psychology assessments or just psychology assessments in general could really help understand yourself and then in turn understand you as a trader, which could help you understand why some of your trades might not be working out. So it's like we said before, you're not a bad trader. You might just be trading the wrong types of assets or trading the wrong type of strategy or whatever it may be. Just like Tom Brady, what should not play running back or center. He's a QB. It's, he would be a bad football player in theory if he played running back. But, we all know he's not a bad football player. It's just, he has to be in the right slot or the right position. What's up, Charlie? Another strategy to overcome these biases, like we're just talking about, is once again implementing systematic decision-making processes and rule-based strategies. So once again, that's systematic decision-making processes and rule-based strategies. These are basically just plans and strategies. I know for those of you who are in BTC Jay's, in Jay's coaching program, he is very, very, very much about implementing systematic decision-making processes and rule-based strategies in his trading when it comes to his technical analysis strategy. It's very simple. It's, he uses different technical analysis strategies, whether it be fair value gaps, Fibonacci, support and resistance levels, swing highs and swing lows, to develop price points of interest. And then he just uses, once again, a systematic strategy to get in and to get out of those trades, based off of that. So, for those of you who, are interested in something like that, that's why the coaches program is just so important. Because, once again, this one way to overcome these cognitive biases is to have a strategy, is to have a system, is to have a plan, which we teach in those coaches' corners. Another way is to include clear entries and exit criteria in your trading. And that's not, I mean, before you enter a trade, it's good to have a clear entry and a clear exit criteria. Honestly, forget even before you enter the trade, like with Jay's strategy, for instance, for people who are swing trading, obviously day trading is a little bit different, but for swing trading, you could have an entry and exit strategy for a trade that you don't get into for another 3 months, until it actually hits your entry, strategy or entry criterion. So it doesn't even have to be like right before the trade, figuring out, all right, I'm going to enter here, exit here. You could, set up your chart, months ahead of time, just wait for that price to get to that level. And it could take months, it could take a few days. We have trades in that, those blog trade swing ideas that Jay does that, a few of them took, a month or so to hit our entry. So, we charted out the play, and then we just kind of waited, set an alarm, and then waited for the price to hit entry, and then boom, now we're in. We charted that out a month ago. So we had a clear entry and exit criteria prior to even entering the trade. Using stop losses is also really important to limit losses, or even just like a custom indicator like StockSbuddy to help determine bullish or bearish trends in trades we're in. Once again, learning one of our coaches, trading strategies, and diversifying your portfolio are a bunch of great ways to reduce the impact of individual biases. So basically, it's just to take out these biases. And one way to mitigate them is to be confident in your trading and have a plan that works and that you follow and that you can follow. One that ideally has stop losses involved and entry and exit criteria ahead of time. And once you have that down, all those biases don't really matter as much because you're just simply trading. That's all trading. Trading should be, not stressful, and you shouldn't have your emotions involved. You should be able to manage them. Recognizing cognitive biases in trading behavior requires self-awareness, humility, and careful observation. I know a lot of people, some people at least, when it comes to traders, they think that either they learn a certain strategy or whatever it may be, their way is the right way, and they are right. And that lack of humility often does hinder a lot of traders in their overall trading journey. So there are some ways to determine which biases us as an individual may have in our trading. And these are not bad things to have. Everyone has emotions. So, admitting that, I have, XYZ emotion during my trades, I let XYZ bias get the best of me. It's not admitting weakness or fault or whatever. It's a way to grow as a trader. And, you're not going to ever grow and develop and, and learn, if you're not able to admit, your faults, because then you won't be able to, change the faults because you'll just keep doing them over and over again because you don't see them as faults. And that leads to people blowing up their portfolios. Let's see. So once again, there are some ways to determine which biases us as an individual may have in our trading. One is just constant reflection and self-assessment, just as people and as traders. This means taking time to reflect on our past trading decisions and outcomes, just our past trades, basically, determining whether we exhibited any patterns of behavior that align with common cognitive biases, such as anchoring to past prices, overestimating our abilities, or following the crowd without conducting independent analysis. So just realizing, times that, maybe, any of those things happen, either you anchored to a past price or, you were anchoring to a price that people were talking about on Webull, and, you had that as your target and you were, determined to sell there, even though the charts were telling you that you should have locked in profits before it hit that target or whatever it may be. It's just being able to realize when these things happen and then realize, oh, it looks like I lost during this trade, or like 10 trades I lost, is because of this one bias. Now I need to be aware of that in my next trade and, be able to, assess when that might be happening, in the future so that we can cut it off before it even happens. So basically it's just seeing, which biases happen often, finding patterns, meaning triggers. So for instance, we might find ourselves suffering from anchoring bias in a negative way when listening to a certain news station or social media account. That might be the the pattern is, I keep, whenever I listen to this one, this one social media account, or whenever I listen to Webull comments or, this XYZ news station, I usually end up, taking the trade and usually end up losing. So now, all right, well, that's the constant is, listening to that news station or social media account, whatever it may be. And so you might know to cut that out. You wouldn't know that if you didn't write down your trades and, journal your trades and have this constant reflection and self-assessment. We might suffer from overestimating our abilities on a trade after having a winning day the day before. So, for instance, whenever you have a huge, 5 good trades in a row, or a huge winning day, whenever, let's say, whenever you hit 10% on the day, maybe the next day you realize that you usually end up losing that day, or having a red day, and that's a pattern. So finding these patterns is how we can figure out ways to stop these from happening before they begin. So in this case, you realize to yourself, all right, yesterday I had a 10% day. Typically speaking, in the past, when they had 10% days, the next day my emotions are running way more than they would normally because I'm on a high from those big wins. I have overconfidence bias or whatever it may be, whatever emotions are letting me or are dictating my trades are happening because, I'm on a hot streak and, might be overconfident or might be XYZ. And it's just finding these patterns is how we figure out, this is what's happening. This is why it's causing my losses. Now I know how, now I need to find ways to manage that. So for this instance, might be, after having a 10% day, just being uber aware, just super aware, of your trades and, maybe cut yourself off after, a certain amount of trades, whatever it may be is, once again, just trial and error, figure out, what your, I guess, your pill or, your fix would be for these, for these emotions. We all have symptoms of being emotional traders is about figuring out what the medicine is, or what the the cure is, or just way of managing it. Because typically we can't cure these emotions. It's just like people with diabetes. You can't people, they can't typically cure it, but they find ways to manage it. Same deal with trading. We might have XYZ bias. We might not be able to get rid of that emotion or get rid of the bias, but we can find ways to manage it. So finding patterns is how we can figure out those ways to stop these, or is how to figure out ways to stop these from happening before they begin. We're almost here at the end. We're going over to trivia in a second. It's also recommended to maintain a detailed trading journal. I know a lot of y'all have probably heard this a million times, where we record our thoughts, emotions, and rationale behind each trade. By reviewing past entries, we can identify recurring biases or patterns in our decision-making process. So just look for instances where emotions may have influenced your decisions, or where they may have where you may have overlooked contradictory information. And so, once again, we're talking about that the bias where you want to be right, and so you ignore information that's going against your thesis. You're either your bullish or bearish thesis, even though that information makes sense. You want to be right, you want to be bullish. You want the stock to go up, you want to make money, and so you ignore the news, or you ignore the bad earnings, or you ignore the the bearish pattern on the chart, whatever it may be. It's and that can typically lead to losses. So look for instances where emotions have influenced your decisions. See when things like this might have happened. Once again, that's by just having a trading journal. We have our trading 201 for those of you who are free, and our trading 301 for those of you who are premium. In those channels, we have like trade journal templates that you can use just to track your trades, or just track your emotions as well in said trades. There's also in our trading, actually in both the trading 201 and 301 course, there is a software that I use. I made a class about as well that you can use to kind of track, what days you do well, what hours you trade the best, and all that kind of stuff. Because all these are just patterns. It's good to to realize what your patterns are as a trader, so you can put yourself in the best position possible. Just like with baseball, the managers ahead of time see, this pitcher's pitching, these batters typically and do better against this pitch. They set up ahead of time, based off of what's going on. And same thing with trading. It's good to realize, all right, well, the market's doing this is let's say it's a red market right now. This XYZ is happening, and typically when that happens, I trade either poorly or really well. And so if it's poorly, maybe I'm going to take a step back for the day or not trade as much. If it's well, then I'm going to take advantage. Just being able to kind of just understand all this is just through journaling and through trade tracking. It's also great to seek feedback from peers, mentors, or trading coaches. It doesn't have to just be, Lee and Bull. It could be, just asking, Charlie asking I am good MC about a stock, or Victoria's asking, Charlie about, their portfolio, or whatever it may be. It doesn't have to be a trading coach or mentor. Your peers are great when it comes to seeking feedback to see what other people are thinking. A fresh perspective from anyone, just from any outside perspective of their own trading bubble, can help identify biases, or outside of their own trading bubble can help identify biases that may or may not be immediately apparent to the traders themselves. So, we might not see things that others do. And so that's why it's beneficial to have communities like this you can, bounce ideas off of. Because, I might have certain biases that make it so that I don't see what Charlie can see. And because Charlie can see it, and I asked Charlie the question, Charlie answered it. Now I have better information, for this trade that I wouldn't have gotten on my own because of my emotions and my biases. Hot mic, there I go. So some traders, this isn't for everyone, but some traders may benefit from taking behavioral assessments or personality tests designed to identify cognitive biases and psychological tendencies. I know that we have the trading psychology assessment in our trading 201 course. Also in the Get a Coach channel, there is that trading assessment as well. Trading what's it called? The Third Trader test. All right. So that is really, really important. Is just to for some traders is to take those, take these assessments or personality tests, is to see who you might be as a trader in the market. These assessments can provide really valuable insights into us as individual traders and our individual trading styles and preferences, which can help us better understand our individual strengths and weaknesses. Also, just be sure to pay close attention to emotional responses during trading sessions. This is like just during the trading day. You got a hot mic there. I'm good, MC. Notice any psychological cues such as increased heart rate, sweating, or tension, which may indicate a heightened emotional state of mind. We can use these cues, these symptoms of emotional trading, as signals to pause and reassess our decisions to help avoid emotional trading. We can also analyze trading performance metrics such as win to loss ratios, average trade duration, days of the week where we made the most returns, and just other facts like that. Basically, like that trade tracking software that I use, tells you all that kind of stuff. And it's just looking for patterns or anomalies that may indicate the presence or lack of cognitive biases or emotional trading could be super helpful, just for us to learn, about our trading in general and help us in the future. So I do have a few questions here for y'all. It's just yes, no questions. I'm curious to see how many people. I have 25 questions, so I'm just going to go through them really quick and just for just you personally, just keep a tally of how many would be a yes for you. And then I want to see at the end who's in the chat right now. We got Charlie, I'm good MC, Nikki, Stickman, Tagman. What's going on, Tagman? We got Porterhouse, Tick 96, Takac, Vans, and Victorious. I'm curious to see how many yeses y'all get, as a group, or not as a group, as individuals, and see what the common number might be. Who might have more or less than the other. So once again, just keep a tally of which of these you would answer yes to. So do you find yourself becoming overly attached to specific stocks or assets? That's question one. Do you tend to ignore information or news that contradicts your existing beliefs about a trade? Do you often make impulsive trading decisions based on recent price movements? Once again, just keep a tally how many are yes. Do you have difficulty admitting when you've made a mistake in a trade? Do you find yourself hesitating to cut losses on a trade, hoping it will turn around? Do you frequently rely on tips or recommendations from others without conducting your own analysis? Do you feel a sense of urgency to enter or exit a trade when you see others doing the same? That's that herding mentality. Do you become overly confident in your trading abilities after a series of successful trades, like we were talking about earlier? Do you tend to hold on to winning positions for too long, hoping for even greater profits? That's that greed that we were talking about in last class. Do you find yourself avoiding trades that involve unfamiliar markets or assets, whether it be crypto or whatever it may be? Do you tend to focus more on potential profits than on potential risks when evaluating a trade? Do you often ignore warning signs or red flags in the market because you're overly optimistic? Do you have difficulty sticking to your trading plan when emotions run high? Do you frequently compare current market conditions to past trades, even if they're not directly related? Do you feel pressure to follow the actions of our trades? Do you feel pressure to follow the actions of other traders, even if it goes against your own instinct? Do you become defensive or dismissive when someone challenges your trading decisions? Do you have a tendency to hold on to past successes or failures when making current trading decisions? So does your past trades dictate your future trades? Do you feel a sense of panic or anxiety when the market moves against your position? So if you're in a bullish trade and the stock starts to go down, do you feel anxiety or panic? Do you often second guess your trading decisions after the fact, especially if they result in losses? Second guessing your strategy. A few more here. Do you find yourself avoiding taking profits on winning trades because you believe the price will continue to rise? So holding on to a trade that might have already hit target because you think it's going to continue to go up. Do you feel a need to constantly monitor the market or check your positions throughout the day? Do you have difficulty sticking to predetermined risk management rules, especially during periods of high volatility? 3 more. Do you tend to ignore fundamental analysis in favor of technical indicators or vice versa? Do you become overly fixated on short-term price movements, losing sight of long-term trends? And last one, do you have difficulty accepting feedback or constructive criticism about your trading approach? All right, so that's 25 questions. I'm curious to see how many of those would be a yes for y'all. And for those of you who are watching after the fact on YouTube, I would love for you to post in the comments or maybe in one of the chat sections. You can tag me to say how many of these 25 questions you said yes to. These questions are basically just assessments of people who might have cognitive biases in their trading. So people who might have closer to 25, might have more than others when it comes to these cognitive biases, or might have to be more aware than others when it comes to cognitive biases. And once again, just because you have them doesn't, doesn't mean you're going to be a bad trader. It doesn't mean anything wrong at all. It just means to be aware. Some of them might be positive biases. Some of them might actually be helping you in your trading, but it's just important to be aware. If like I see Victorious, you got 23, Tikak got 8, Tick I think also got 8. Oh, I'm good. MC got 0. Van's got 8. Yeah, 8. Yeah, 8 seems to be the common one there. But yeah, so 8. This is like a nice middle number. Means that there might be some areas where you might have to look into some of the aspects we're talking about in this class. Some of these different biases. Someone I see Victorious with a 23. Once again, not a negative thing. So like for me, I have that bias with Uber. Where I just learned that one chart and that worked out well for me. So it's not like a bad thing, but it's realizing when it is a bad thing and realizing when these biases aren't going in your favor and these trades that you're losing are because of a common pattern that is a bias, whether it is anchoring or overconfidence or fear, greed, whatever it may be. Oh, Chick got 23. Yeah, I think when I did, I got like around like 18, or I think it was. And once again, not a bad thing. It just means that, you might have high emotions just in general, in trading in life and whatever it may be. And sometimes that could be a positive thing. And sometimes that could be a negative thing. It's just really about whether or not you're able to manage those and to be aware of them, and see which ones are negative and either cut those out or manage them, and see which ones are positive and really lean into them. It's just finding your strengths and your weaknesses as a trader. Just like, with anything in life. So I am Stick Man got 14. Yeah. So it looks like Victorious and Tick got the two most. I am good C. It's at least with 0. And then that middle number, that Tikak, we got Tikak Vans with 8 right in the middle. I'm curious to see what people, after the fact get. But yeah, so this was our week 3 session, our trading psychology stream. I will be posting the recording in our Trading 401 class under section of our Discord channel under our trading psychology course. Next week is going to be week 4. We'll be going over risk perception and risk management. I know everyone talks about risk management. I've heard every single one of our analysts talk about risk management. I've heard all the YouTubers out there talk about risk management, but what a lot of people don't talk about is risk perception. So we'll be understanding risk perception in trading next week. We'll be assessing risk tolerance and risk appetite and implementing effective risk management techniques. So it's not just about managing risk, not just about having a risk to reward ratio or having a stop loss or a target. It's also just, understanding what risk perception is, how it works for you personally as a trader, and understanding, what your personal risk tolerance is, and different ways or different reasons why a higher or a lower risk tolerance might work for you in different markets and different conditions, in different, maybe even different assets, whether it's crypto versus stocks versus maybe futures or options, and just kind of, realizing your individual risk appetite and seeing if that lines up with what it should be, based off of, your emotions in trading. So futures, I am good MC is a great question. Here, let me go back to the chat so people can see that question. So futures trading is very similar to options trading. With options, it's basically just trading these contracts. With options trading, you are buying the right, but not the obligation to buy a certain amount of shares at a certain time by a certain date. With futures, it's basically the same thing, except minus basically it is an obligation, is basically what you're buying. So like with futures contracts, like a lot of people, start off with like if I sell corn, or I buy corn, whatever it may be. I'm a farmer. I have corn, and I want to. Someone is buying corn from me, and they don't want to deal with the fluctuations of the corn market. But they know that they're going to need corn for the next year, 2 years, 3 years. In fact, because I love corn. So people can get a futures contract, which basically just says, I am buying the right. I'm buying a contract that lets me buy your corn, buy corn at this price, in the future. Oh, you're saying corn. Yes, I am saying corn, Porterhouse, or wheat or barley or whatever it may be. So these futures contracts are just basically contracts that basically just like options, but it's the big difference is that is not the there is with the options is the right, not the obligation. With futures, it is not only the right but also the obligation. So a lot of people use them in commodity trading or just commodities in general. With oil, a lot of countries, use futures contracts or what, I'm buying to buy oil. I don't want to deal with, the price of oil goes down or goes up or whatever. I want to buy this many barrels of oil at this price and I'll get them at this date and at this date and at this date. It's just ways to hedge against market volatility. And then there's traders like us who can speculate on those contracts, just like we speculate on options contracts with, the price, the premiums going up and down. So it's very similar to that. We actually do have a trading one or I think there's actually two. I think we have two court. No. That's come on. Is that futures trading or do we have Forex? No, I think it is futures. Yeah, we have two futures trading classes in our Trading 101 course. I think I was going to do one futures, one Forex, and I totally messed up and did two futures by accident, but then we did a Forex class afterwards. So, but yeah, that's a great question. I am good at MC. So I am going to go ahead and end the recording. We're going to go ahead and go right into the trading trivia part of the stream. So for those of you who are watching after the fact, appreciate y'all tuning in. We do this every Wednesday, 5 p.m. Eastern, followed by trading trivia with prizes. Hope to see you there. But until next time, I hope that you all make some bread.